Cheniere, Valero, Chevron, EOG, Halliburton, Kinder, Apache, Hess, ONEOK, Exxon, EQT, Phillips 66, Oxy. I mean, go down the list. Bryn, they like these stocks still. Do you?
For sure. I mean, if you're going to look, if you had one metric to analyze a company, that's it. PE, price to sales, PEG ratio, et cetera. The single best metric historically you could have used is free cash flow yield. And when I look at the energy sector as a whole, it right now has a free cash flow yield of over 11%. To give some perspective, the S&P is about 4. The next biggest sector is communication services at 6. And so it's like these companies are being financially responsible. They're paying down debt. They're doing smart buybacks. They're giving more back to shareholders. And so, yes, the commodity of nat gas and oil is volatile. And I think that's why they're still cheap, is a lot of people just don't believe it. But when you have a sector that is now the 4th biggest contributor to the S&P by earnings, if you don't own the sector, I think you're just continuing to miss out on high-quality cash flow, especially when people want income and yield.
Joe, your names are all over this list. EOG, Pioneer, Valero.
So far in 2023, the relative outperformance in energy equities to the spot price of oil and natural gas is astounding. Energy equities are up 4.5%. Natural gas is down 25% so far year to date. Oil is struggling to maintain a 2% gain. We are experiencing a significantly warm weather both here in the U.S.
Gas is $3.
Both in the U.S. and in Europe. Everyone told you that a weather event was coming in Europe and in the U.S. And if you sat back in your chair and said, OK, well, on January 23rd, it never happened, where would energy equities be? You'd say they'd be down 10%, especially given 2 consecutive years of outperformance. But yet here they are, outperforming once again. And to Bryn's point, it goes back to the balance sheet. It goes back to disincentivizing them to take the incremental dollar of revenue that's being generated and putting it back in the wellhead. They're buying back their shares. They're focused on the dividend. They're repairing their debt. And that's exactly why you want to stay with energy.
Steph, Chevron, Oxy, you just added to Schlumberger on Friday, SLB, Diamondback. You agree with Adam Parker?
Yes, I do agree with Adam. The valuations are so cheap because earnings are going higher. Every single quarter, earnings are going higher. Free cash flow, as Bryn and Joe mentioned, really is the key stat, right? They're printing money at oil at this price. They're printing money at oil even $10 lower than where it is currently. So I like the visibility in terms of earnings. I like the fact that their CapEx has come down over the last many years. They've underinvested. Instead, they're returning it to shareholders in dividends and buybacks. And so, yeah, Schlumberger was a great quarter. They beat earnings. They beat revenues. EBITDA came in 3% ahead of expectations. And I've always talked about this company being a hidden technology gem. And their digital and integration margins were up 380 basis points sequentially. So that is just really fuel for the fire. No pun intended. Fuel for the fire for the story, in my opinion. It's not cheap, but they have the best momentum and international activity as well.